What's up, guys? To recap, we have learned first what stock is, second how the modern stock market works, third the difference between common stock and preferred stock, lastly authorized issue, treasury, and outstanding stock. Today we're going to talk about EPS, earning per share. Earnings per share, or EPS, is one of the most important concepts and one of the most widely used ways to gauge company profitably. This is basic concept. If net income goes up, EPS goes up. If dividend on preferred stock goes up, EPS goes down. Finally, if number of common stock outstanding goes up, then EPS goes down. EPS matters because strong earnings tends to drive the price per share up, and that's good for investors. Earnings also generate money the company can reinvest in growth. But EPS has limitations. If a company uses earnings to buy back shares or its own stock, there are fewer outstanding shares in the equation. That drives the EPS up without any actual increase in earnings. EPS also doesn't consider outstanding debt or that two companies might have the same EPS, but one company used less capital to generate the same profits, indicating it might operate efficiency. So while EPS is a fundamental factor in assessing stock value, it's most useful when considered along with other metrics such as PE ratio. Price to earning ratio, or PE, is a way to value a company by comparing the price of the stock to its earnings. The PE equals the price of a share of stock divided by the company's earnings per share. It tells you how much you are paying for each dollar of earnings. In other words, what you're willing to pay for every $1 of EPS. Low or high PE ratios aren't inherently good or bad. Here we have 4 different cases showing different PER compared to S&P 500 PE ratio 21.82 as of June 12. Case 1. When a PE ratio is low, it could mean that investors are losing confidence, selling shares and driving the price down, while earnings hold steady. A good example of this is Pfizer. Pfizer's stock price took a dip due to its failure to breast cancer drug Ibrance. Case 2. The PE could also be low if the company's earnings grow quickly, before investors notice and start buying shares, driving the price up. PER of Berkshire Hathaway is only 0.03. That's why Bill Gates puts 50% of his money into this stock. Similarly, a high PE could result if investor excitement drives the share price up while earnings remain low. Amazon is a good example of this. High PE may be justified if the company is poised for growth. Nvidia is a good example for this. Make sure you research companies carefully. Compare the company's PE to others in its industry and analyze any inconsistencies. I apologize in advance that my laptop ran down after automatic Windows 10 update is done. So I was not going to be able to update my investment ideas for space industry in this episode. Today, I've discussed about one of the most important concepts in stock, EPS and PER. Next time, what I'm going to do is to briefly explain about how FAT works and my investment ideas for space industry stocks. Hope you guys enjoyed today's video and you're going to show me some love by smashing thumbs up button and leave me a comment down there on your opinions. See ya!